Coin-margined futures. What is a coin-margined futures contract? Coin-margined futures contracts are a type of derivative that derives its value from an underlying cryptocurrency. Unlike USDT margined contracts, the margin and potential P&L of coin-margined contracts will be denominated in cryptocurrencies such as BTC or ETH instead of USDT. Investors should understand what contract codes mean in order to understand expirations. Contract codes typically convey information about its underlying asset, quote asset, and expiration date. Let's use the BTC USD perpetual coin margin contract as an example. The first code, labeled BTC, refers to the underlying asset, in this case, Bitcoin. The following code, USD, refers to US dollars, which is the quote asset. Lastly, perpetual refers to the term maturity of the contract. In this case, perpetual contracts allow traders to hold positions without an expiry date. In addition to perpetual contracts, Binance offers quarterly contracts which offer a slight variation. Quarterly contracts have a limited lifespan, and they will expire based on their respective calendar cycle. For instance, a BTC USD December 25th quarterly contract expires on the stipulated expiration date, which is December 25th. How to use a coin-margined futures contract? On the Binance webpage, click Derivatives, CoinM Futures. And on Binance app, tap Futures and choose CoinM, and you're there. Choose your margin mode and adjust the leverage. There are two types of modes, cross and isolated modes. And then transfer your assets into your coin-margined wallet. You're all set. Users may choose the contract size. Coin-margined contracts use contract as a unit to specify position size. Each contract represents 100 USD. When you open a position, remember to use TP/SL order to set prices in the take profit and stop loss fields to manage risk. Please pay attention to your margin ratio and ensure sufficient funds in your account. Coin-margined contracts benefits. 1. Hold and earn. If you are a minor or long-term holder, coin-margined contracts are ideal for you. As coin-margined contracts are denominated and settled into its base currency, traders can simply fund the initial margin in cryptocurrency such as BTC. Especially in this bull market today, investors are more inclined to hold on to their cryptocurrencies. As contracts are settled in the underlying cryptocurrency, any profits can contribute to your long-term stack. Furthermore, as prices continue to rise, the value of your collateral will increase correspondingly. This is simply a great way to increase your cryptocurrency holdings over the long run. 2. Shared margin. Users enjoy synergies between the coin-margined products. Any profits made can be used for margin on either the quarterly or perpetual futures contract. This is particularly useful for those hedging between the two markets. 3. Customized margin modes. Binance offers cross or isolated margin modes for coin-margined products. Users can allocate assets to isolated positions or share the collateral across all open positions on cross-margin mode, which is quite flexible. Expand your trading opportunities with coin-margined futures contracts today, with up to 125 times leverage.